Welcome to today's market report.
World stocks sold off sharply on Monday while safe haven assets gained as troubles at property group China Evergrande fed concerns about spillover risks to the economy, sparking fresh investor worries ahead of a busy week of central bank meetings. MSCI's gauge of stocks across the globe shed 1.63%, its biggest one-day percentage four-day in about 2 months, as Wall Street's benchmark S&P 500 sagged 1.7% and tech-heavy Nasdaq tumbled 2.2%. Investors moved into safe havens, with US Treasuries gaining in price, pulling down yields and gold rising. Shares in Evergrande, which has been scrambling to raise funds to pay its many lenders, suppliers and investors, closed down 10.2% at 2.28 Hong Kong dollars. Regulators have warned that its $300 billion of liabilities could spark broader risks to China's financial system if its debts are not stabilized. It started with the problems with China Evergrande real estate company, and it's just become a contagion. Everybody was kind of afraid of September for this very reason. It seems to be the month that you have significant sell-offs, and here we go. The Dow Jones Industrial Average fell 1.78%, and S&P lost 1.7%. Nasdaq was down 2.19%. Economically sensitive sectors, including financials and energy, were hit particularly hard. Still, stocks paired losses late with US indices ending above their session lows. The Pan-European Stock 600 index lost 1.67%, with mining stocks sliding. The sell-off on Monday has seen a cumulative $2.2 trillion of value wiped off the market capitalization of world equities from a record high of $97 trillion hit on 6th of September, according to Refinitiv data. Worries over Evergrande come as a rally in equities has stalled recently, with investors focused on the impact of coronavirus cases on the economy and when central banks will ease back on monetary stimulus. The US Federal Reserve is due to meet on Tuesday and Wednesday as investors look for when it will begin pulling back on its bond purchases. Investors were also keeping an eye on other central bank meetings spanning Brazil, Britain, Hungary, Indonesia, Japan, Norway and the Philippines, South Africa, Sweden, Switzerland and Turkey. The offshore Chinese yuan weakened versus the dollar to its lowest level in nearly a month. Benchmark 10-year last rose 30 seconds of 60 in price to yield 1.3158% from 1.37% late on Friday. The iShare exchange traded fund tracking high-yield corporate bonds fell 0.4%. US crude settled down 2.3% at $70.29 per barrel. Brent settled at $73.92 per barrel, down 1.9% on the day. The spot gold added 0.6% to $1,764.30 per ounce. On the FX front, GBP/USD is declining for the third day in a row, down 0.61%, trading at 136.57, while the market sentiment remains downbeat as Chinese real estate developer Evergrande scrambled to fulfill its bond interest payments due this week, triggering a global sell-off of everything that has the risk word attached to it. Additionally, the possibility of the Fed announcement of reducing its bond purchasing this week also weighed. The dollar index, which measures the box performance against a basket of 6 currencies, is flat, sitting at 93.24. Meanwhile, in the UK, the Bank of England will meet on 23rd of September. In the last meeting, Michael Saunders voted to finish the bank's bond purchasing programme, but most MPC members kept the pace unchanged. Concerning a raise of interest rates, BOE's Governor Andrew Bailey commented that 4 out of 8 MPC members thought some initial conditions had been met to raise rates to explore the possibility of raising interest rates. Nevertheless, this seems remote by investors as the market expects a rate hike by 2022. The euro-dollar pair started the week under modest bearish pressure and dropped to its lowest in more than 3 weeks at 117, with the greenback struggling to preserve its strength in the second half of the day. The pair managed to erase its losses and was last seen trading flat on the day at 117.25. Risk perception is likely to remain the primary driver for dollar-linked pairs.
This is today's market news. Thanks for listening. We'll see you next time.